I'm Tim Hilger. I'm Spiedel's senior editor. I'm also out on the speaking trail. Welcome, everybody. Well, we got a nice present under the Christmas tree this year, an extender bill. And what made it especially sweet is that some of the provisions were made permanent. Before we dive into what the extenders are, let's backtrack and talk about where these extenders came from. At the risk of sounding like an old fuddy-duddy, back in the old days, a tax law was a tax law, and it stayed a tax law until it was amended or repealed. What changed? Well, it was the Byrd Amendment in 1998. The Byrd Amendment required the government to do a 10-year budget. Now, keep in mind that all of these extenders are tax benefits to taxpayers, meaning they subtract from the federal budget. So say, for example, you have a certain deduction that's worth $1 billion a year in the aggregate. If it's made permanent, then over that 10-year budget, it hits the federal budget to the extent of $10 billion. But if it's only good for 2 years, it only impacts that 10-year budget to the extent of $2 billion. And that's why we keep getting extenders. It's a silly exercise. It's a shell game. It's a form of kicking the can down the road. So as silly as it is, what makes it even sillier and more aggravating is that usually Congress doesn't get around to extending the tax law until well into the tax year. So taxpayers don't know what the tax effects are of their actions. Well, this year we got an extender on December 18th, making it even sillier because it was just before the holiday break. We knew they were going to deal with it on that day, and in fact, in one day it passed the House, the Senate, and was signed by the President. And for obvious reasons, we've all dealt with this dilemma. Should I be more concerned about $1 trillion or about catching my flight? No brainer there. So we got our extender with some permanent provisions. There were over 50 provisions up for grabs. About 20 of them were made permanent. So we're making some real progress. Let's dive into those provisions now. First, we have the $250 teacher deduction, the above-line deduction. That provision was made permanent. Not only that, it will be adjusted for inflation starting in 2016, and in addition, continuing education tuition costs now count as qualifying expenses. So think of it as CPI and CPE, the Consumer Price Index and continuing professional education. The above-line tuition deduction, that one was extended through 2016. The sales tax deduction as an itemized deduction, that one was made permanent. It is now permanent. The deduction for mortgage insurance premiums, that one was extended through just 2016. Now keep in mind, California does not conform to that provision and will never conform. Three big bill provisions regarding charitable contribution deductions. The deduction for certain conservation contributions made permanent. The adjustment for S corporations upon the deduction of property made permanent. Now, prior to the Pension Protection Act of 2006, when an S corporation donated property, presumably with a fair market value in excess of basis, each of the shareholders had to reduce his basis in his stock by the amount of fair market value. It was a big hit. And so the Pension Protection Act said, no, you only have to adjust it by the basis of the property. That provision has now been made permanent. Also made permanent, the enhanced deduction for contributions of food inventory. This is a fairly big deal. Food processors would be happy to donate food to homeless shelters. The problem is they're in business, they're business people, and there are costs associated with packaging and moving that food. This deduction helps tip the scales and makes it so they're more likely to make that contribution. The enhanced child tax credit made permanent. Also, there are new due diligence requirements, and I'm going to get to that in just a second. Let me move on and say that the American Opportunity Tax Credit has been made permanent. And also, it has new due diligence requirements. Now, this is going to be up to the IRS. We have new due diligence requirements with respect to the child tax credit and with respect to the American Opportunity Tax Credit. So what's the IRS going to do? Presumably, it's going to be something along the lines of the due diligence requirements we already have for the Earned Income Tax Credit. But are we now going to have 3 separate due diligence forms, or are they going to adjust the Form 8867 to accommodate all 3? That remains to be seen. The non-business energy property credit extended through 2016. The solar credit has been extended in kind of an odd way. Through 2019, the credit percentage remains at 30%. Beginning for purchases made in 2020, it falls to 26%, and then it falls again in 2021 to 22%. The enhanced version of the Earned Income Tax Credit, that version for 3 or more qualifying children, has been made permanent. Over on the business side, bonus depreciation has been extended. Now through 2017, it remains at 50%. Now keep in mind that bonus depreciation is always on a calendar year. Regardless of the fiscal year of the entity, bonus depreciation is on a calendar year. So to get that 50% bonus, you have to have it purchased and placed in service by December 31st, 2017. Then we begin a phase down. For assets placed in service in 2018, we're at 40%, and in 2019, we are at 30%. Also, there's something new called qualified improvement property, qualifying for bonus. This is for work done to the interior of non-residential real property, but it does not include the actual structure of the building. We're going to need guidance from the IRS about exactly what is qualifying property. The big present under the tree this year, though, was enhanced 179. Now, 179, as of 2014, was at $500,000 with a $2 million phase-out limitation. That is now made permanent. Not only that, but beginning in 2016, both numbers are going to be adjusted for inflation. So this is a big deal. Without this provision, we would have gone back to $25,000. That would have been the lowest since 2002. It is now made permanent and adjusted for inflation. Now, 179 for the qualified real property, those 3 classes of qualified real property, restaurant property, leasehold improvements, and retail improvement property, that provision is made permanent. Not only that, because it's made permanent, the expiration of carryover is no longer an issue. If you have excess 179, you may keep carrying it over. Furthermore, the special $250,000 limitation on this kind of property has been repealed. And so it's just thrown into the mix with all other property subject to the $500,000 limitation. Computer software, off-the-shelf computer software as qualifying 179 property has been made permanent, as is the ability to revoke a 179 election without permission from the IRS has been made permanent. Also, new property eligible for 179, heating, ventilation, and air conditioning units, HVAC property. Now again, we're going to need a little guidance from the IRS regarding this. 15-year depreciation for those same 3 classes of property: restaurant property, retail improvement property, and leasehold improvement property. 15-year depreciation made permanent. Now, luxury auto limits without bonus depreciation for 2015, those limits would have been $3,140 in 2015. We needed bonus to kick it up by $8,000, and we got that. So we'll get that $8,000 bump up through 2017. But along with the phase down of bonus depreciation in 2018 and 2019, we have a phase down of that $8,000 bump up. In 2018, it'll be $6,400, and in 2019, it'll be $4,800. And just like with bonus depreciation, if it's not extended past 2019, we'll go back to just the basic depreciation amount. Transportation fringe benefits, the enhanced version has been made permanent. The small business stock exclusion under Section 1202, the 100% exclusion has been made permanent. Now, keep in mind that the property, the stock that is tagged according to the purchase date. So, we had a 100% exclusion beginning September 10 in 2010. Any stock bought after that date gets the 100% exclusion, but stock purchased before that date is tagged with whatever exclusion amount was in effect at that date. So it might be 75%, it might be 50%. Now, California lost its small business stock exclusion a couple of years ago, so there's no equivalent for California purposes. The 5-year built-in gains holding period has been made permanent. Now, California does not. The research credit is made permanent. This was the longest standing extender we had. This one actually went back before the Byrd Amendment. We've been worried about extending the research credit for about 25 years. Finally, it's made permanent. Not only that, it's enhanced in a couple of ways. Number one, the credit can be applicable against AMT for certain small taxpayers, those with gross receipts of $50 million or less, and for even smaller taxpayers, those with gross receipts of $5 million or less. It's actually applicable against the employer's share of FICA. Now, exactly how that's going to work, we don't know yet. That too will require guidance from the IRS. The Work Opportunity Tax Credit, that is extended through 2018, and it's been enhanced. For hires happening in 2016 or later, it qualifies for long-term unemployed individuals, so an enhancement of the Work Opportunity Tax Credit. The Section 181 deduction for film and television production, that has been extended through 2016, as has 3-year depreciation on racehorses. The Cadillac tax has been delayed until 2020. The Cadillac tax was set to go into effect in 2018. That implementation date has been pushed back 2 years to 2020. Now note that there is considerable bipartisan support to completely repeal the Cadillac tax. Of course, Republicans are always eager to gut any part of the Affordable Care Act that they can. Well, it turns out that a lot of Democrats are in favor of repealing it too. The reason is that this is a tax on high premium health plans, and a lot of labor unions have negotiated very generous benefits, including very generous health plans. And of course, labor unions generally side with Democrats, so a lot of support on both sides of the aisle to repeal the Cadillac tax. The exclusion for discharge of debt on a principal residence has been extended through 2016, so discharges occurring on or before December 31st, 2016. And there's a special provision that says that you can also exclude gain on discharges occurring in 2017 so long as there is a written agreement that was in place during 2016. Now, California has not conformed to this. California's principal residence exclusion expired after 2014. So if you have an exclusion occurring in 2016, you can still exclude it for federal purposes, but not for California. So for California purposes, you're going to have to look at one of the other exclusion provisions under Section 108, such as the one for insolvency. The IRA to charity exclusion, that has been made permanent. So individuals who turn 70 and a half can direct their trustee of their IRA to direct funds directly to charity. It's not taken into consideration in any way. And the good news, California actually conforms to this provision. And our final provision today is under Section 529, college savings plans, enhanced in a couple of ways. First of all, the temporary provision that allows allowable expenditures include computer and software equipment. That provision has been made permanent. Another provision, a brand new one, also permanent, there is now the equivalent of a 60-day rollover. So if you take a non-qualifying distribution, you can roll it back into a 529 account for that beneficiary within 60 days and treat it as if nothing happened. So a very good Christmas present for all of us. That's what we have for now, and thank you for watching.